Good morning and welcome everybody to the Lock in Your Success Options Trading for Income Weekly Update for August 25th, 2014. Before we get going, I'd like to remind you that the presentation is for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please note that we do use hypothetical computer-simulated trades, which are believed to be as accurately represented as possible. Also, the risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. And please trade responsibly. If you're watching this on some other venue, such as YouTube, come on over to our website and check out our programs, the M3 Bearish Butterfly ROCK, M21 Group Coaching, and Trading Triangle Coaching programs, and join our mailing list and get your free report, 7 Secrets to Becoming a Successful Trader, and sign up for the weekly webinar. And as always, stay tuned for what we got coming out. All right, let's take a look at what's going on in the markets. Last week we were thinking that I was a little bit bullish short term, and we were thinking that the NASDAQ breakout was going to pull the market up to the resistance levels. And in the Dow, we were talking this 1700 area or possibly previous highs. So that pretty much happened in all our indices. The NASDAQ continued to break out. The Dow came up into this 1700 area. The SPX came right up to its all-time highs, backed off in a little bit, but kind of stationed there for Friday. And we had the Russell, which came up to the top of this resistance range, which is pretty much what we were expecting for the week. So the question is, where do we go from here? Well, because the Dow still has a little way to go before all-time highs, and it wouldn't be terribly surprising to see the market reach for that. And the futures are up this morning, right? So it would be a surprise, although they're not up, just to be clear, they're not up high enough actually to break the highs of last week yet. So this isn't a clear indication yet. But should we break the highs of last week, this is probably coming to pull into all-time highs, maybe slightly exceed them, and then we're probably going to back off. So judging by this index, that's what I would expect for the week. I'd expect us to either roll over here or possibly come up to previous highs and then roll over and have some sort of a retracement. The depth of the retracement at this point is difficult to tell. However, we should at least retrace some off of this level should we get here. So for the SPX, that means that if we're looking at our shorter term charts, we will probably pull into this trend line up here at around 2000, 2005, depending on how long it takes to get there. So slightly higher on the SPX. And like I said, although we did break a little higher than our all-time highs, I wouldn't consider this a clear breakout till we get over this trend line area here that's off of this diagonal area. Delta tops often have an extension a little over the previous highs before they roll over anyway. So this wouldn't be a terrible surprise. And as far as what's going on with well, let's look at the NASDAQ quickly. The NASDAQ has no overhead resistance. However, should the Dow take a shot up for all-time highs, NASDAQ would probably pull into this next Fibonacci at the 4085. So from there, I expect the market's probably to roll. The Russell, we've mentioned this 170 number before. On our shorter-term charts, you can see this window here. This gap window, which should act as a good resistance level for the market. So we usually reach the top of that window, a little over 1170. When Dow, if the timing is right and Dow comes into its all-time highs, it's a good place for the market to roll over. So that's what I would expect. Possibly a little bit higher this week, earlier in the week, and then we're going to roll over for some sort of correction. Like I said, the extent of that correction is a little bit hard to determine at this point. But we'll see how that pullback comes, and we'll make, when new information comes into the market, we'll move forward. So that's what I'm thinking for the markets. If we take a look at our trades, a lot of things happened last week because we had our entry date for our ROCK trade for September. We had our entry date for our Bearish Butterfly for October, and I went ahead and decided that we're going to be doing 56-day M3s for a while just to demonstrate them in the regular time frame. So all those trades were entered. But before we look at those, let's take a look at what we have open. Yeah, Derek, I'll take a look at these market questions after we go over the positions. So yeah, great. Keep them coming though. Keep the questions coming. All right. So position-wise, the September V Condor had no adjustments last week. So it currently looks like this. We're still short here. I haven't touched the V yet. I would say, given what we're expecting in the market for it to push a little bit higher, I would be fairly comfortable pulling this V. I wouldn't pull it completely out, but I'd certainly widen it a lot. So more than likely, at some point today, I'm going to be taking this V and widening it out, locking in our profit probably at around $3,000. And if the market continues up, we still have the delta should still be pretty good. So I'm actually planning on widening this V out today. But as of last week, this did not have any adjustments, and this is what the position looks like here. So the next issue would be taking a look at the September Bearish Butterfly, which did have a little bit of action last week. If we go back to, just quickly go back to Monday, we were sitting in these 1120 butterflies, and we're starting to have delta theta ratio problems. Therefore, I did choose to hold this with a poor delta theta ratio on Monday. However, when we did our adjustment, I wanted to make sure that I rolled to 1140 before adding the 1160s, and that's what I did. So I believe it was on Tuesday, we came ahead and rolled that 1120 up to 1140, added the 1160, and we're currently, if you'll take a look at the T-log, this was done during the day on Tuesday. Actually, I added in my 1140 and 1160 and then sold the 1120. That's the way I went into it. And this position here is now entered 2/3, has another add point at about 1180, and we're currently about 1-to-1 delta theta ratio, which is really nice. Down slightly as of Tuesday. And this is what the position looked like there. If we roll this ahead to Friday, I believe it's up a little bit as of Friday. Yeah, about $1,000. Obviously, today's going to beat the heck out of that. With we got a 7 or 8 point gap is what we're looking at to open up. So we'll probably draw down a little bit here. Should the market really take off here, go to 1110, it's going to be kind of a pain in the neck. I think it'll take the move to 1110, but it'll definitely draw it down quite a bit. Should the market reverse at the 1170 level like we think it's going to, then this should be looking really nice for the month. All right, so I have just a question on elaborating on widening the V condor. So let's just skip back to the V condor for a sec. So what we're going to do with this trade here is I'm getting positive delta even though I'm towards my call side. Plus there's a danger here where this, because we're getting close to expiration, where this T+0 line is going to start to collapse in here. It hasn't happened yet, but it will start doing that. So that being the case, if I was up a little higher in price, and this is what may change my mind too about widening this out. If I was up, if today comes in here and we have some sort of an explosive move to like 1180, I'd leave this alone because at that point I'm not concerned about too much about my poor delta, my poor theta levels and stuff. But realistically, if we get up to the 1170 area here, this area is going to start to collapse on me, and I'm going to start getting a lot more positive delta. So I'm going to be in a much tighter trade per se. So to fix that, what I'm going to do is come in here and just sell these off and probably roll them about 50 points. We'll see where the market lands later on, but 1, 2, 3, 4, 5. Roll these out into something like this. Probably actually even a little bit wider than that. I'd probably want to lock in about 3,000. So I go even push this wider and maybe another 20. I haven't really looked at this in detail yet, but I just know I just know I want to widen it. I want to take the straddle out a little bit. If I come that many points, yeah, that locks me in at around 3,000. Puts me in a pretty wide, safe position, and at that point, before I get into too much delta problem with this thing, I'd have to be up in the, let's see, 1194 area. And of course, if any time goes by, that gets better and better. So this I don't think is a really bad position, even if we do go to 1210. It'll draw down a little bit if we do that, but this is a nice looking position. So that's what we do on the V condor. Should the market not, yeah. So I'm turning a straddle into a strangle. That's all, and that gives me, that locks in my profit. Should the market do what I think it's going to do and just kind of back off, that should bring us a $3,000 profit for the month. I may even widen the straddle out a little bit, maybe bring in 3,500 should the market stop. But it brings us into a nice smooth gain for the month. All right, so we kind of went over, oh shoot, I didn't mean to convert that, I apologize. So we went over the V Condor, went over the Bearish Butterfly. Let's take a look at September M3 trade. This also got a couple of adjustments this week. We had to roll it. So let's go back to Monday morning. Yeah, so I'm asked if I have a rule of when I widen the V on a V Condor. In general, if I'm in the center of the position and there's no or very little theta in the position, or the Vega turns positive, I will widen it out to prop that up a little bit. And if I get positive delta, like we are now, and I'm to the, if you're looking at the analyzed graph, if I'm significantly to the right of the V and I'm getting positive delta, I'll usually widen it out. So under those two circumstances, I tend to widen it out. It's not a hard guideline. And some people never widen them out at all, but I like to do that. I am sacrificing a little bit of profit should the market continue to go up, but I'd rather play that one on the safe side than the aggressive side. Okay, so this is the position we were sitting in on Monday afternoon. So Monday, let me go to Monday morning or earlier in the day. So coming into the week, we had 15 shorts at the 1100 butterflies, 15 shorts at the 1100, 5 shorts at the 1110. We had our call at 1100, and this is what the position looked like. Started exceeding my maximum delta that I like to have when I'm outside the tent. So if we've been watching this for a while, I'm willing to carry around minus 75 near our break-evens. I'm willing to carry about minus 50 outside and minus 100 if we're well inside. So we're certainly well outside this area here, and we were pulling well over minus 50 by the end of the day. So I came in here and I just put in 5 1100, 1110 verticals. And this is what we look like at the end of the day on Monday. So up a little bit, about break even. Delta is still slightly more than I wanted it to be, but that's close enough, right? That's not a big deal. That's close enough. So then we came in here on the 21st, which I believe is Thursday, right? The 21st was Thursday. And at that point, we were, let me just go to the midday here, because I did this a little bit throughout the day. So at this point, according to guidelines, being 10 points over our long strike, we had, at the time, I actually did the adjustment. Let's see what happened here. I guess we weren't that high at 10. Yeah, okay. Yes, there we are. So we're 1060. I believe the day before this, we were 1060. We're positive Vega. Let's just go to the previous day here. I'm trying to remember my thinking here. Well, I guess we're not positive Vega, but we're pretty flat Vega. I thought we were a little bit higher than this, which was interesting. But let me see. Anyway, we didn't do anything on Monday at the end of the day anyway. Yeah, we're fine Monday. Actually, it was Thursday we did this, right? So let's go to Thursday. Here we are, Thursday. We are over, by the end of the day, we were over, or a little later in the day, we were over 1160, 10 points past our long. We were in the positive Vega range. Basically, it's time to do an adjustment on this. I can't do any more verticals because if I do more verticals, it's going to put me positive delta. I don't really want to be positive delta. So this being the case, it's basically time to roll this thing up. So I came in here and we rolled this 20 points. We went from the 1100 shorts to the 1120. And from there, we're a little more aggressive in the verticals. So if you come to the end of the day, you can see that I'm repositioned here up 20 points with 1120 shorts, 5 shorts at 1130, 5 at 1140. Did not move the call. Everything's fine there. Still sitting at about minus 46 delta, but at this point our Vega is solidly negative. Our theta is nice and positive. And here's what the position looked like as of Friday. Let's just go to Friday. So gain a little money in the meantime. Slightly more than minus 50. However, I'm just at the break even. So this was perfectly fine. No issues here, and this is what we're looking like here. So I don't have another roll-up adjustment on this until about the 1180 area, and this is looking pretty nice right now. If we come up into the 1170s and back off, this should be a good trade for the month also. And let's see, the last September trade would be the September ROCK trade, which was entered on Wednesday. The good thing about, or the interesting thing about this month is this is the first ROCK trade in a long time that we've been able to actually enter as a ROCK trade. We've been entering an M3 position a good part of the year. Volatility's been a little bit too high, but and even last week I thought I was going to enter this as an M3 trade also. But I came in, I did the entry test on Wednesday. It was clearly telling me to go into a ROCK position, so this is what we did. We entered 10 1140s. We entered 5 1180s. Let me just shoot up here to Friday. There were no adjustments to this position. We're sitting at about minus 183 delta, which is perfect. Not perfect for the opening this morning because we're going to get a gap up. We're going to draw down a little bit, but this is actually a pretty nice position. As far as entering this as a ROCK trade, this actually was not my, I'm not thrilled to do that. In other words, I'd rather actually enter this as an M3. And my reasoning for that is because we're at some sort of a resistance level, and I wouldn't be surprised to get a reasonably big move either way. That being the case, I don't really want to be in this high gamma position, but that's what the rules put us in. So I went ahead and did that. Because that's what we're doing. We're just kind of following the guidelines within the programs, and this is where it put us. So that's what we have for our September ROCK trade. So I have a couple of questions. I have a slippage question, which we can address a little bit later. All right, so what's my next move on the September M3 if the market keeps going up? Will I roll the 1140s to 1150s? So let's just go back to, before we get into October, we'll go back to September. So here, yeah, so if the market continues to go up here, what we do is we control our delta to stay in the minus 50 level here, and we're also trying to control our Vega number because we like to keep these negative Vega up in this area. So that being the case, the market comes up into here. If I either have a volatility or theta issue or I have a delta issue, then more of these short strikes are going to be rolled forward. If rolling the short strikes forward to correct a Vega issue, for example, is going to put me a positive delta or not enough negative delta where I'm happy with it, then I'm going to consider rolling the butterflies up in one form or another. Now, as a beginner type of person, what you would do is you just roll the butterflies up when that happens. You'd roll them up probably 20 points. If you're more advanced, you can do some other things. So you can start splitting these strikes out. In other words, if we go back to, Wednesday? What day did I move this thing? I moved this thing on, and this is going to answer your question too, Dave, I think, on Thursday. But let's just go to Wednesday. All right, so here I am Wednesday. I'm positive Vega. I'm negative 47 delta. So the delta is not an issue, just the volatility level is an issue. So if I come in here, I can fix my volatility problem by doing this. Right. That puts me minus 110, but sometimes when I do that, I might not like, I might either go significantly positive delta, or I might not like my downside risk here. That being the case, then I would want to roll the position. I could do something more advanced, though. I could do this anyway and say, hey, I don't like my delta because it's this corrected my Vega, but I don't like the delta issue because it's too positive. I could take some of these. This is probably too many, but just as an example, I could take some of those and roll them up, bring myself back to minus 45 delta, still maintain a nice high theta level, still maintain nice negative Vega. So this would be an alternative adjustment to doing the roll-up if you want to do something a little bit more gradual. If you wanted a little bit less delta, you could do that too. You could do like 3 of these or something, and that was going to pull you maybe minus 29 delta. If you're liking that number better, you can pull into something like that. See how we, even though we're not that far from expiration, we can keep a nice flat T+0 line with there's very little risk in this position here once you get your volatility significantly negative from price movement standpoint. So you could do that. It's a little more risky to roll up because if you get a hard pullback, then obviously you don't have as much room. So the reality is coming into a resistance level that you think I might get a big move off. I'd almost rather do this than do the roll up. But this is just a different type of an adjustment that you could have done, rather than the roll up. So that's a little bit more advanced thing. As far as why more verticals did not work, they just put me too positive delta. I decided to do the roll-up. Now, in my live position, I actually did not do that roll-up. I did something more along the line of this because I am concerned about a significant pullback off of this level. And of course, I even with this big move up, I still don't have any risk here. So I was more along that line. But as far as the guidelines go, the guidelines tell us to go ahead and do the roll up there, and that's what we did on the website trade. So that's what that looks like there. All right, and I think that's everything. That's everything on this position. All right, so that's all the questions on our September positions, I think. All right, so let's go to October. We had an October V Condor, which actually had no adjustments. We'll just come to Friday. This here, I can't, the position's so wide I can't show it all on one screen here, but essentially we have our short strikes at 12:30 and 10:30. We have our straddle in here at 11:30, and which was positioned again in the same place as September, which I didn't like, but that's the way it turned out. This is what the position looks like. Taken on, I think, about minus 70 delta. It's at about break even as of Friday. So, nothing to worry about here. Continue that move. We're going to start buying back these 12:30 shorts. But so far, it's just a standard position. So not a whole lot to talk about there. And if we go to the other two positions we actually put on are an October Bearish Butterfly, which I'm not, I like this position this month. I'm aware that I see a market top at 1210, which is 50 points. So if or at least a temporary market top for the Russell at 1210. So, that being the case, if we run that 50 points, this is going to draw down. It'll be a pain in the neck, but it should do okay. So I'm not overly concerned about entering. Is it the optimal entry? Yeah, I don't know that it's the optimal entry, but it's certainly nothing I'd be scared of at this point. I mean, the market's been up enough, and I do think we're going to roll over to 1170. So chances are this shouldn't really even be a problem this month. But it's a decent entry. So this is what the position looks like. We entered in at the 1140s. We did not have a delta theta problem yet, although you can see our delta theta issue is getting a little bit higher now because the market skew is starting to come into the markets, as evidenced by our entry for the ROCK trade. And that's the last thing was an October M3, which I entered a little bit further behind the market than 20 points. I had a choice of going in 22 points behind or 32 points behind. I went in 32 points behind. I added 5 verticals here, 1130, 1140, and I also have the 1100 call in here. This position looks like this, nice and flat T+0 line. I can withstand a reasonably large down move, and that move really isn't a problem. So that is that's it for the positions. That's everything we have on. So I'm going to kind of get into the questions a little bit here. Let me go back to the first one if I can. All right, so the first thing is just a market direction question. What would indicate to me that the correction or pullback from the 1170 won't happen? I would say that if we come into the charting things here, let me go to the SPX. Let me go to a yearly chart for a second. So looking for the SPX making a significant break of the 2000-2005 area. Now, the SPX doesn't usually get much more than it is now over its 20-day moving average. So that being the case, if you go back, like, one of the techniques we use in the M21 program is moving average extensions, is how far over the 20-day moving average or the 50 or the 200 is the market. The SPX doesn't go a whole lot. I mean, it'll go more than 50 points sometimes, but it's kind of rare. Usually an indication the market's kind of tired and it's likely to actually have at least some sort of a sideways move, if not an all-out retracement. So, that being the case, it's going to be really unusual for the market to go too much higher than it is now in the SPX. However, a breakout to 2005 or higher, certainly a close at that level, along with the Dow breaking into new highs, then I'm thinking the Russell's just going to go to 1210. By the time the Russell gets to 1210, where's the market going to stop if it goes up is your next question, right? Where's the NDX? I don't have it here. Let me look. The market will stop when the NDX is 4150. So should the market break out, for some reason it's just crazy bullish, we have a nice area. The NASDAQ being the leader, you want to know when the NASDAQ reaches its price pattern targets, and it reaches its price pattern targets at around 4140, 4150. So that's should we break out, that's when the market's going to turn, and that's where I'm going to watch how the Russell's coming into 1210. Again, the SPX here doesn't have a pattern target till way, way high here. It's not going to have a pattern target till around 2081, but the reality is with the moving average extension, it's not going to have that kind of energy to get there. The NASDAQ will have that kind of energy to get to that point, which will roll over the SPX sooner than that. It'll probably roll over the Russell at 1210, and it'll probably also pull down on the Dow. So that's what I'm thinking for upside movements. Right now, we don't have a clear technical breakout in anything except for the NASDAQ. We'll have to see where today closes. I'm thinking today's more of a blow-off move that's going to that's probably going to reverse out, maybe run up to 12, like I said, 2005 maybe, blow off and then drop out. What's going to change things is depending how the Dow comes into its all-time highs, but that's what I'm thinking at this point. All right, so if it rolls over, do I think Russell can break the 1100 area? Yeah, we don't really have an indication of how low it's going, but let's look at the 1100. Right, you'd almost have to look at shorter-term charts for this. Right, so we have a resistance level here. 1150 would be a spot to retrace to. Our next spot would be here, 1135. Our next spot would be here. I don't think that this would break 1100 at this point, even with a decent retracement. I mean, you might get 50 points off of 1170, which brings us to 1120. Yeah, I mean, the market would. I mean, you should see that coming. I mean, you need to see the NASDAQ break some support levels. If you start seeing the NASDAQ break some serious support levels, then we might have a chance of breaking 1100. But the reality is a market pullback is probably going to pull us down to 3,900 or about 4,000 on the NASDAQ, and that's going to pull the Russell down some. But I'm not expecting a tremendously deep pullback here. I'd be very, very surprised if we break 1100. All right, let's see here. I'm just trying to push through some questions. Got that one. We got that one. What do I make of the fact that bonds are going up at the same time as stocks? I don't really take what bonds are doing into my stock analysis. I just do pure charting. So, from a pure charting level, that's what I think. I don't watch those. All right. So, how are the moving average extensions measured? They're just measured. What's the moving average? How far up, over, or under the moving average are we? And it's just a point calculated value. So I don't do that with Fibonacci's. I'm sure you could easily do that with some sort of a spreadsheet. What's the 20-day moving average at? What's the index at? How far is that? You could probably import that data fairly easy into a spreadsheet. I just I just calculate them manually. I just look at them. I know how far that each index moves from its moving averages. It's something I look at every single month, and I just calculate it manually. All right, so have you any slower to adjust the October M3? Oh yeah, I'm not worried at all about the October M3. That's like there's nothing urgent that can really happen here. The only thing that would affect it, make me adjust an October M3 like right away would probably be if the market absolutely collapsed, right? If you get a really strong down move, you do have that downside risk, so you got to cover that. You got to cover that. So as far as the upside, yeah, I'd be slow to adjust it for sure. And let's see what else we got going on here. I'm sorry, I just have a lot of things I'm trying to read through. All right, so the next thing, I think this is actually the last question. It just has it's a slippage question. How do I set up slippage set in an option view? Option view I set up with no slippage. The reality is, actually, I did a blog post on this. So look at my blog, lockeandyoursuccess.com. Just go to my website, and I just did a blog article on this because I got another question on slippage. The reality is there's a process by which we go by to price these spreads, and a certain way that we adjust them, especially you get up into the M21 program. The reality is you can usually beat option view prices, and I say usually, not all the time. It depends on what the things. But on average, with my live positions, I execute at better prices than what option view tells me on a position. Like I said, that's not all the time. It's probably 85% of the time. I'll do at least as well or better, and probably 15% of the time we do worse. And the 15% of the time we do worse, one or two things are happening. The market's either going against the position and it's not giving us an opportunity to adjust efficiently, or in other words, I have to do something even though I may not want to. And the other reason would be some days there's just no volume and pricing's just really crappy. But that's far outweighed because most of the time, especially doing these positions, if you're trading these properly, you're not putting yourself in a position where you need to get a trade on. Like if it's 56 days to expiration and you want to enter a trade, you don't have to get in that trade today. You can get it tomorrow. You can get it the next day. You can start early. But and you make your movements when it's advantageous to you. I mean, if you're always making your movements when the price is going against you, I mean, if you're the way to get the absolute worst execution is to sit there and watch the market and say, oh, the market hit, the Russell hit 1800, and now that means I have to do something, and you try and force it. If you do that, then yeah, you're going to have poor execution. But if you follow the tips that we give you in our more advanced programs about execution and stuff, then you should be able to actually work out better pricing than what you have in option view. A lot of times I'll have significantly better pricing than what I have in option view. You can buy calls under mid when the market's coming down, but you're not going to buy them under mid when the market's going up. So it's just a matter of watching that and doing that. So yeah, I mean, you may want to, as far as an option view setup, the slippage settings in option view stink anyway. Like I said, the program is very effective for us, but as far as a slippage adjustment that's standard, that's just not realistic. That's less realistic than having no slippage. And if you want to put in, if you know you're trading and you've tried these a little bit and you are having some sort of a problem keeping up with option view. So in other words, what I do when I trade, right, is I put the trade in option view and I just convert it randomly, right? I just convert the trade. And then I'll execute it, or I'll do it the other way. I'll execute it, and then I'll just randomly convert it in option view. And you can see how you're doing with execution by comparing if your actual pricing, if you're worse off with actual pricing or better off with actual pricing than you are with just converting it in option view. Most of the time, I'm much better off actual pricing than doing the conversion, is randomly converting it in option view. So, but if you do that regularly, and you find you're one way or the other, and you want to add the correction in, whether you want to correct that you're executing better or worse, then you can go ahead and put it in there and have some sort of a correction factor for you. The reality is, if you practice, if you take the tips that we give you for execution and you practice them, you should be doing better than option view execution. Okay, so yeah, so just the execution thing again. So mostly getting better prices by entering when the market is going with you. Yeah. So the whole concept with the bearish butterfly, right, is to enter the market when the price is screaming up in a butterfly that's below the market. One of the things we know about those conditions is that the butterflies, they collapse in price. They get extremely cheap. So it's also the time people are most afraid to enter them. And that's because no one knows where the market's going, but you can get really good prices there. You can get below mid prices. You get amazing fills and stuff like that. And you can make money that way. The M3 you kind of get offset because you're trying to buy the M3 entry price. You kind of get offset because you're trying to buy a butterfly and then a call. So you're going to get, if you do that with an M3, you're going to get taken advantage of on the butterfly. But, I mean, you're going to do well on the butterfly. You get taken advantage of on the call. But if you know that going in, you don't have to chase it, right? So I'll put in a really good price for butterfly because that's the bigger part of the position. That's the one with the most variance in pricing. And then I'll put in a price over mid for the call. I know I'm going to get screwed on the call. I know that ahead of time. Unless I'm timing the market and I wait for it to come down, which is a little bit dangerous if you're an M3 trader, unless you're really good at technical analysis and stuff. But I don't usually do that either. I put the butterflies in, I overpay for the call. I know it's going to happen. I make sure I do mid plus whatever when I get into the call. But realistically, the pricing averages out because I usually do better than mid on the butterflies, worse than mid on the call, and it kind of averages out. And then with the adjustments, we start getting retracements in the market and so forth. In other words, yeah, the market's going up right now. It's hit my adjustment point. That's okay. I can sit on it for a while. Really, in an M3, you should never be in a position where an up move is going to kill you if it continues to go. Most of the time, you're better off to wait a little bit, wait for the market to retrace, and then go ahead and buy your upside adjustment. You see, what happens with people is they say, oh my goodness, the market's going up, I need to adjust. Okay, I need to adjust, and then they force themselves into adjustment and they get screwed on an adjustment, right? So that's like I said, the worst way to get that. I mean, if it's something you absolutely need, then you have to pull the trigger and you have to do it and know you're just going to get taken advantage of. But the reality is 90% of the time you can wait for the market to at least stall or maybe come back at you a little bit and then do the adjustment. The problem comes in is when people go past an adjustment and then the market reverses on them and they say, oh, I don't have to do the adjustment anymore. No, that's not the case. The market, you've made the decision point where you're making the adjustment. You've made the decision. Now you're waiting for the opportunity to do that. The market just gave you the opportunity. Take it. If you're wrong, that's fine, but at least you did really well in execution on getting that move in there. You didn't. It's not like if you do it the other way, you overpay for the adjustment and then you get hammered on it on the reversal. At least if you wait it out, you hit the reversal, then you make the adjustment. You've gotten a really, really good price in that adjustment, and the execution is really good. It doesn't hurt you nearly as much. So, and it's certainly not going to hurt you as much than if you wait too long and then, in other words, you get the reversal, you don't take it, and then it really takes off. Right. So anyway, that's just some notes on execution and so forth. All right. So it's well past our end time of 9:30. So and I think that's all the questions. So I hope everybody enjoyed the presentation today, and we'll see you next week.